Hello students, welcome to the lecture on market-based ratios, and after this lecture we will be able to learn the following objectives. Explain the earnings per share, explain the price earnings ratio, understand the market price to book value ratio, define the cash earnings per share ratio, explain the book value ratio, explain the dividend yield ratio, understand the Dupont analysis. Let's start with the concept of market-based ratios. Information level is one of the most important factors which determine financial market efficiency. Investors can increase their profits according to the impact of this information on stock prices. Efficient market is one in which investors cannot profit by using the existing information in the market. Information gathering from financial tables is the basic information which investors use in investing. Through financial ratios from these financial tables, investors seek the way to get abnormal returns. The market where investors can get abnormal returns by using past prices or financial ratios is not weak form efficient as well. Investors can diversify their investments by examining the present value and estimating the future value of their companies. Let us now discuss the earnings per shares or EPS. Earnings per share are a company's total earnings divided by the total number of shares outstanding. It is calculated using annual earnings, usually after interest and taxes and after deducting the preference shares dividends, so as to compute the portion of total profit which is attributable to the ordinary shareholders. In this case, total earnings would be divided by the total number of ordinary shares outstanding. Moreover, different accounting policies regarding the handling of new issue of ordinary shares have led to the need of several computation approaches to the EPS ratio in order to reflect in the best way possible the appropriate information for the users, stakeholders of the firm being analyzed. For this reason, there is the computation of the basic EPS, the EPS adjusted reflecting any bonus issue or right issue or options or warrants exercise, and the diluted EPS, DEPS, which reflects the convertible bonds or shares to ordinary shares. The approaches are being determined by the accounting policies in effect.
In this video, we're going to talk about how to calculate earnings per share. So if we remember from other videos, we've got net income at the end of a quarter, at the end of a year, and what we're going to do is we're going to spread this net income among a pool of shareholders, right? So we've got all these different shareholders, and we're going to spread this net income. We're not actually going to pay it out, so it's just more theoretical practice what we're doing here, but we're trying to get an idea of how this net income would be divided up among the shareholders. What's their share? What's their claim on that net income? So let's go ahead and let's get to the formula for how we would go ahead and calculate this. So we've got net income, and then we subtract out preferred dividends, right? Because what we want to get here is we want to get an idea of the amount of net income among the common shareholders. So net income, we subtract out this any preferred dividends that are paid or so, and then we're gonna scale everything by the number of common shares outstanding. So it might be a little bit easier to understand it if we have an example. So let's say that we have XYZ Corporation, and XYZ Corporation has, let's say they have net income of $30,000, and then they have preferred dividends, preferred div of $4,000, and then shares outstanding. Now we're talking about common shares. So common shares, and again, we take the weighted average of the common shares throughout the year. Common shares outstanding, we'll just assume common shares outstanding, we've got 50,000. So now we need to make some calculations here, and we're just going to plug in to our formula up here these numbers. So let's get started. So we've got in the numerator, we're going to have 30,000, this net income. And then we're going to subtract out the preferred dividends because the common shareholders don't have any claim on that. That goes to preferred shareholders. So now we're going to divide this whole thing by the number of common shares outstanding, not total shares, common shares. So we got 30,000 minus 4,000 divided by 50,000. And what's that going to give us? That is going to give us 52 cents a share. So one way of thinking about how the earnings, this earnings of $30,000, so one way of thinking about how, what share of the pie each shareholder has, we can think of it for every share you own, you really have a 52-cent share in those earnings. So now we can think about a couple things that are a little more complex in terms of these preferred dividends that we're talking about here. What if the preferred dividends are declared but not paid? So the company has declared that they're going to have a preferred dividend, but they haven't yet paid it. Do we go ahead and then deduct it in terms of calculating our earnings per share, even if they haven't been paid? The answer is yes. We go ahead and we deduct. Even if they haven't been paid yet, if they've been declared, you deduct them. Now, what if the preferred dividends are cumulative, which I'm going to explain this in another. If you don't know what this is, go to my other video about preferred dividends. But what if they're cumulative, but they haven't been declared? Do we then deduct them from here? Because again, we've got this here. What do we do with the preferred dividends? Well, even if they haven't actually been declared, but they're cumulative, we go ahead and we deduct them in our calculation of earnings per share as well. So whether or not the dividends have actually been paid, if they've been declared, or whether or not they haven't been declared but they're cumulative, we're going to go ahead and we're going to deduct those preferred dividends from net income, scale everything by the number of common shares outstanding, the weighted average throughout the year, and that will yield our earnings per share, which in this case was 52 cents a share.
Now let us study the price-earnings ratio, or the PE ratio. The price-earnings ratio, or the PE ratio, provides a comparison of the current market price of a share of stock and that stock's earnings per share, or EPS, which is figured by dividing a company's net income by its number of shares of common stock outstanding. For example, if a company's stock sold for $30 per share and it posted earnings per share of $1.50, that company would have a PE ratio of 15. A company's PE ratio typically rises as a result of increases in its stock price, an indicator of the stock's popularity. A company may post an artificially high PE ratio as a result of factors that can neither boost stock prices or diminish earnings per share. Restructuring charges, merger and acquisition rumors, whether true or false, and high dividends yields all have the capacity to push a company's PE ratio upward. In other instances, legitimately high PE ratios can be adversely impacted down the road by such factors as market conditions, technology, and increased competition from new rivals. Conversely, while a low PE ratio is often a good indication that a company is struggling, appearances can again be deceiving. In addition, different industry sectors often have diverse PE ratio averages. A company may have a fairly low PE ratio when compared with all other corporations, when compared with the other companies within its industry, however, it may be a leader. Let's now talk about the market price to book value ratio, P over BV ratio. The price to book ratio formula, sometimes referred to as the market to book ratio, is used to compare a company's net assets available to common shareholders relative to the sale price of its stock. The formula for price to book value is the stock price per share divided by the book value per share. The stock price per share can be found as the amount listed as such through the secondary stock market. The book value per share is considered to be the total equity for common stockholders, which can be found on a company's balance sheet. The use of price to book value formula. The price to book value formula can be used by investors to show how the market perceives the value of a particular stock to be. A ratio over 1 implies that the market is willing to pay more than the equity per share. A ratio under 1 implies that the market is willing to pay less. Cash earnings per share ratio. Cash earnings per share indicates the amount of operating cash flow per share. This ratio is similar to EPS. The only difference is that in this formula, cash flow is used instead of net income. Cash earnings per share are a common indicator of a company's financial performance. Data to calculate this ratio is collected from the statements of retained earnings and cash flow statement. Companies' cash earnings per share can be compared with other companies' cash EPS. That is why it is important for the investors. While making a comparison to other companies' ratios, earnings per share of current company must be divided by its nominal value or the face value of the share.
With our financial statements in hand, the fundamental analyst's goal is to determine quality, undervalued stocks and then buy them in anticipation of the appreciation that should occur when this value comes to light. We've already discussed how to determine the financial strength of a company. Now we need a means of assessing whether the company is attractive from an investment perspective. To do this, we'll need to apply a range of market performance ratios that will assist us to identify value. As usual, the ratios will in most cases need to be compared to prior periods and importantly with other companies to identify trends. For calculation purposes, we will assume a current share price of $15 and $7 for last year. Just as we kept a scorecard when we assessed the financial strength of ABC Company, we will do the same here, as ultimately we want to form a view as to the attractiveness of the company from an investment perspective. Let's look at the first of these, the earnings per share ratio. Earnings per share equals operating profit after tax attributable to shareholders divided by the average number of ordinary shares outstanding during the period. This gives us a means by which we can determine the amount of profit earned for every ordinary share on issue. Earnings per share is the most common method of expressing a company's profit or earnings. We will see shortly how earnings per share is compared to share price for a meaningful comparison ratio.
Book value ratio. Book value means the value of the equity that is owned by shareholders according to the financial statements. Book value is calculated from the balance sheet. Book value is usually shown directly on the balance sheet as the total equity value. Usually the total equity or the book value is a subtotal that adds up the value of the original common share dollars invested in the company at the IPO and any secondary offerings including amounts received for warrants and options plus retained earnings. Often there are a few other smaller items added in such as gains and losses on foreign exchange rates. Alternatively, book value can also be calculated as the total asset value minus all the items on the liability side of the balance sheet that are not part of common equity. Book value is also referred to as the net asset value since it is the value of assets net off after subtracting all debts and liabilities of all kinds. However, in recent years, net asset value has also been used to mean net market value of assets rather than the accounting book value. Some companies use preferred shares. These should not be included in the calculation of book value. Some companies legally but rather annoyingly show these preferred shares in the same subtotal as common equity and in that case they have to subtract out. Book value per share calculation. Unless anyone is Warren Buffett, he is not likely going to buy the whole company. Therefore, he was interested in book value per share. To calculate the book value per share, divide the book value by the current diluted number of common shares outstanding. Often the number of shares is shown directly on the income statement. The diluted number of shares can also be calculated by dividing the latest quarter net income by the diluted earnings per share in the latest quarter. If there has been a share issue in the quarter, this will not be completely accurate, but it is usually close enough. Additionally, we can find the number of shares in the notes to the financial statements under common shares. Ideally, we should use the diluted number of shares, but we can use the actual number of shares at the quarter end if the diluted number is not provided. Did you know that the dividend yield fell out of favor somewhat during the 1990s because of an increasing emphasis on price appreciation over dividends as the main form of return on investments? Dividend yield ratio. The dividend yield ratio shows the amount of dividends that a company pays to its investors in comparison to the market price of its stock. Thus, the dividend yield ratio is the return on investment to an investor if the investor were to have bought the stock at the market price on the measurement date. Divide the annual dividends paid per share of stock by the market price of the stock at the end of the measurement period. Since the market price of the stock is measured on a single date and that measurement may not be representative of the stock price over the measurement period, you may consider using an average stock price. Dupont analysis. The Dupont model, developed in 1914 by F. Donaldson Brown of chemical company Dupont de Nemours and Corporation, is a set of financial ratios and key figures relating to the return on investment (ROI), return on equity, financial expression, Efficient use of assets is important for the profitability and the growth of any organization. One of the easiest ways to gauge whether a company is an asset creator or a cash user is to look at the return on equity (ROE) ratio. ROE is a strong measure of how well management is creating values for shareholders. In its simplest form, ROE is calculated as annual earnings divided by the shareholders' equity. If the result of this basic ROE ratio increases over time, it is generally considered a good sign. However, the ratio can also rise when the company takes on more debt, increasing the leverage but decreasing the shareholder equity. A risky situation. To avoid the false positive that the simple ROE calculation can give, the Dupont analysis, a more in-depth method of determining return on equity, was developed in the early 1900s. The components of the Dupont analysis: net margin, net income or sales. This ratio measures after-tax profitability, how much profit a company makes for every INR 1.00 it generates in revenue. Net income and sales figures can be found on the income statement. Generally, the higher the ratio, the better. It should be noted that in order to generate more sales, management might reduce the net profit by reducing the prices. Lowest cost firms like Walmart have used this strategy very effectively. Asset turnover, sales or total assets. This ratio indicates the amount of sales generated for every dollar's worth of assets. This evaluates the firm's efficiency in using its assets. Typically, the higher the better. However, this ratio tends to be inversely related to the net margin, that is, the higher the net profit margin, the lower the asset turnover. The sales number to calculate this ratio is found on the income statement. The asset figures, however, come from the balance sheet. Income statement items are measured over an interval of time, while balance sheet items are measured at a specific point in time. This difference can skew the result. Therefore, rather than using total assets, it is a good idea to use average assets to ensure meaningful ratio. Leverage factor, average assets and average shareholder equity. This ratio determines the extent to which the company relies on debt financing. The higher the number, the more debt the company is carrying. Averages are used to control any potential bias that may be caused by end-of-the-year values. Advantages or uses of the plus points of Dupont analysis chart. While choosing which assets to include in a portfolio, an in-depth analysis of the investment alternatives is made. If one of the alternatives is an ownership share in a corporation, then it is observed that the Dupont ratio is the best tool that is used to analyze that investment. The Dupont model was internally developed by Dupont as a tool to measure its investment projects, but eventually became widely used as a financial tool. The Dupont analysis breaks down a company's return on equity (ROE) into three components: profit margin as measured by net income as a percentage of sales, asset turnover, which is net sales divided by the total assets of a firm, the degree of financial leverage as measured by the equity multiplier, which is the ratio of total assets that are financed by stockholders' equity. In formula form, Dupont return on equity is ROE equals to the net income divided by the total stockholders' equity, which is equal to profit margin into asset turnover into equity multiplier, or ROE equals to net income upon total stockholders' equity equals to net profit upon net sales into net sales upon total assets into total assets upon total stockholders' equity. Profit margin indicates how efficient the company's management is in operating the company and in controlling costs. Asset turnover, on the other hand, measures the efficiency of the company in generating sales for every dollar of asset. Lastly, the equity multiplier shows how leveraged a company is by computing how much financing stockholders provided for every dollar of asset. Using the Dupont system in evaluating alternative stock investments helps investors in comparing why ROEs of these stocks differ by identifying the impact of operating efficiency, asset use efficiency, and financial leverage on the return on equity. It is not enough that each of the stock investment alternatives be ranked according to ROEs, but what contributed to their ROEs should also be analyzed. Of course, the Dupont ratio and return on equity, for that matter, should not be used as the sole investment analysis tool in deciding on what stock to include in a portfolio. Other tools such as the return on investment and cash flows as a percentage of sales or any other income statement item are just few of numerous financial tools that an investor can easily use in investment analysis. Buying a stock is a serious commitment. Hence, stock investment analysis should be taken very seriously. Advantages of Dupont analysis. Fundamentally, any decision that influences product prices, per unit costs, volume or efficiency, productivity, output per unit of the input will impact profit margin or turnover ratio. And any decision that affects the amount and the type of debt and equity used will impact the financial structure as well as cost. These financial concepts are important to understand because every business in the world is competing for capital. Money flows where the perceived risk-adjusted return is greatest. If we as marketers of products and services to businesses understand these financial concepts, we can better understand where we might be able to help our customers the most. We need to understand how we deliver value to our business customers. Marketing value involves much more than a prep rally sales meeting. It is a culture, a mindset, a strategy. To do it well, first define it. Understanding the financial concepts allow to focus on the key questions: how to help the customers, increase the price per unit of product they sell by adding new features and benefits to their products, services and systems, decrease the variable cost to produce, acquire or sell the unit, increase the number of units sold, decrease the overhead by increasing the efficiency of operations, increase the asset turnover by minimizing the customer's work in process of finished goods inventory and therefore total assets. Now in the end, let us summarize what we have learned in this lecture. Earnings per share are a company's total earnings divided by the total number of shares outstanding. The price over earnings ratio, P over E ratio, provides a comparison of the current market price of a share of stock and that stock's earnings per share or EPS, which is figured by dividing a company's net income by its number of shares of common stock outstanding. The price to book ratio formula, sometimes referred to as the market to book ratio, is used to compare a company's net assets available to common shareholders relative to the sale price of its stock. Cash earnings per share indicates the amount of operating cash flow per share. This ratio is similar to EPS. The only difference is that in this formula, cash flow is used instead of net income. Companies' cash earnings per share can be compared with the other companies' cash EPS. That's why it is important for the investors. The dividend payout ratio is the amount of dividends paid to stockholders relative to the amount of total net income of a company.